The global financial system did not collapse. It did not crash. It did not explode. It did not even make front-page news. But in a window of just 96 hours, the foundation of the modern financial world shifted in a way that most people still do not understand. No war was declared, no banks officially failed, no currency was formally replaced, and yet central banks moved. Governments held emergency meetings. Currency traders repositioned billions. And institutions that normally take years to react reacted in days. This was not a market event. This was not about stocks. This was not about inflation or interest rates. This was about power. And power, once it moves, never quietly returns to where it was before. This is not about markets. Most people think the global financial system runs on money. It does not. It runs on settlement systems. It runs on trust. It runs on the assumption that when a nation sends money, the system will allow it to arrive. The dollar did not become the world's reserve currency because America was the richest country. The dollar became the world's reserve currency because it was universal, neutral, and accessible. Any country could use it. Any bank could clear it. Any central bank could hold it. The system worked because everyone believed the system would always work. And then, in a period of just 96 hours, that assumption was questioned. And once trust is questioned, the system does not break immediately. It slowly rearranges itself. Let's go back 96 hours. Let's go back exactly 96 hours. At the beginning of this window, nothing looked unusual. Markets were open. Currencies were trading normally. Oil was priced in dollars. Central banks were holding reserves in U.S. treasuries. International trade was clearing through the same systems that had been used for decades. Then a decision was made, a policy directive, a financial restriction, a settlement limitation. To most people, it looked like politics. To financial markets, it looked like risk. But to central banks and sovereign wealth funds around the world, it looked like something much bigger. It looked like a preview of a world where access to the financial system was no longer guaranteed. And that changed everything. How the system actually works. To understand what happened, you need to understand how the global financial system actually works. When countries trade, they don't ship cash. They don't move physical money. They move balances through clearing systems. Banks settle transactions through international payment networks. Central banks hold reserves in foreign currencies. Oil, commodities, and global trade are priced in major currencies. Government bonds act as global savings accounts for entire nations. The system is not just about currency. It is about infrastructure, payment systems, clearing systems, reserve assets, trade settlement agreements, swap lines between central banks, commodity pricing mechanisms. Together, these systems form the plumbing of the global economy. And plumbing is invisible until it stops working. The reaction, the quiet shift, what happened next, did not appear dramatic on television. There were no emergency broadcasts, no dramatic speeches, no market closures. Instead, something far more important happened. Central banks began reviewing reserve allocations. Trade agreements began including alternative settlement currencies. Energy exporters began discussing non-dollar pricing. Currency swap agreements were expanded. Gold purchases accelerated. Regional payment systems saw increased volume. None of these moves individually looked like a revolution, but together they looked like preparation. Preparation for a world where the financial system would no longer revolve around a single center. The strategic moves over the next few days, a series of quiet but extremely important moves, began to take place. Move 1: Currency diversification. Central banks began reducing reliance on a single reserve currency and increasing holdings in alternative currencies and gold. Move 2: Trade settlement changes. Countries began settling trade directly in local currencies instead of routing everything through the dollar. Move 3: Alternative payment systems. Regional financial systems and bilateral clearing arrangements began handling more international transactions. Move 4: Gold accumulation. Central banks increased gold purchases at one of the fastest rates in modern history, preparing for a system based less on trust and more on physical assets. Move 5: Sovereign debt diversification. Global reserves slowly began shifting away from a single country's debt into a broader basket of assets. None of these moves were announced as a revolution. But revolutions in finance rarely announce themselves. They happen slowly and then suddenly. The market consequences. Markets began reacting, not violently but structurally. Currency volatility increased. Government bond yields moved unexpectedly. Gold prices strengthened. Commodity pricing discussions expanded beyond traditional settlement currencies. Trade settlement became more complex. Capital flows became more cautious. This was not panic, this was repositioning. The difference between panic and repositioning is simple. Panic happens when people are surprised. Repositioning happens when people are preparing, and the world was preparing. What this means for the world for decades, the global financial system operated around a single assumption: one primary reserve currency, one dominant settlement infrastructure, one central financial hub. But systems built around a single center are efficient and fragile. If the center becomes political, conditional, or uncertain, the system does not collapse overnight. Instead, it decentralizes. Trade becomes regional. Reserves become diversified. Payment systems become multipolar. Commodity pricing becomes flexible. Financial power becomes distributed. This does not look like a crisis. It looks like a transition. Let's bring this home. So what does this actually mean for ordinary people? It means currency values become less stable. Interest rates become harder to control. Trade becomes more expensive. Import prices fluctuate more. Mortgage rates become more sensitive to global capital flows. Stock markets become more volatile. Inflation becomes harder to predict, and governments lose some control over their own financial systems. This is not just about governments and central banks. This is about the cost of your food, the price of your house, the value of your savings, the stability of your currency, and the future of the global economy you live inside. Three possible futures from here. The world likely moves in one of three directions. Scenario 1, slow transition. The current system remains dominant but slowly loses exclusivity. The world becomes financially multipolar over time. Scenario 2, financial shock. Rapid reserve diversification triggers instability in bond markets and currencies, leading to a global financial crisis. Scenario 3, managed transition. Major economies coordinate a new system where multiple currencies share reserve status and trade settlement becomes distributed. None of these scenarios return the world to what it was before. Because once financial trust changes, it never fully resets. Final question, the ending. So the real question is not whether the system collapsed. It didn't. The real question is whether the system just began to change. Was this a temporary political event? Or was this the moment the world quietly began moving toward a new financial order? Did the system break, or did the system reveal how it really works? You may not notice the change tomorrow. You may not notice it next year. But decades from now, historians may look back at a quiet 96-hour window and say that was the moment the global financial system began to change. The countdown did not start with a market crash. It started with a decision, and decisions, not markets, are what change the world.